All right, welcome to The Explainer. Today we're diving into something really interesting. An investment analysis on a bank that's literally over 100 years old, KVB A Bank. We're going to look at how this old school institution is trying to completely reinvent itself for the digital age and, what that might mean for its future. So, the analysis we're breaking down today kicks off with a really bold question. I mean, think about it. A 100-year-old bank with a potential upside of over 100%? That just sounds wild, right? It suggests this massive growth potential that honestly seems almost unbelievable for a bank that's been around for so long. Okay, so let's set the stage. At the time of this analysis, the bank's stock was sitting at around 211 rupees. Just, lock that number in your head for a second.
And then, boom, here's the number that makes you sit up and pay attention. The analyst's target price, 425 rupees. That's more than double where it was. So the big question, the one we're here to unpack, is how on earth did they get to that number? What in the world did they see that maybe, just maybe, the rest of the market was overlooking?
Okay, so to really get what's going on with this bank's future, you gotta look at its past. And the first chapter in this whole story is what you could call the Great Cleanup. We're talking about a massive, and I really mean massive, overhaul of its loan portfolio. So let's rewind just a few years to 2021. The bank's level of bad loans, the loans that aren't getting paid back, what the experts call net non-performing assets, was sitting at 3.45%. Now, that might not sound like a huge number, but in the banking world, that's a really big deal. It's a key indicator of a bank's health, and that number was basically an anchor, weighing down its performance. And now, look at this. This is the after picture, the results of all that hard work. By 2024, that bad loan number had absolutely plummeted to just 0.40%. I mean, that's a drop of almost 90%. It completely transformed the health of their books and put them right up there with some of the top-tier, best-run banks in the entire country. And look, this isn't just some boring number on a spreadsheet. This change is everything. It is the absolute bedrock of this entire investment story. Think of it like this. They didn't just repaint a crumbling house. They tore it down to the studs and built a brand new, solid foundation. Now, any growth they add is built on solid rock, not on sand. All right, so the foundation is solid. The books are clean. But now what? Where does the growth actually come from? Well, the answer is in this kind of catchy strategy they call phygital. It's exactly what it sounds like, a mix of their physical brick-and-mortar legacy and a huge, all-in push on digital tech. So a big part of this is how they've structured their loans. They use this framework called SMART, S-M-A-R-T, and it's all about diversifying. They're focusing on small and medium businesses, agriculture, and retail lending. That's the bulk of their business now. And at the same time, they've been really smart about backing away from those big, potentially risky corporate loans. And that T at the end of SMART, well, that stands for technology. And if you had any doubt they were serious, just look at this number. 96%. 96% of all their transactions are now digital. Let that sink in. For a bank that was founded way back in 1916, that is just a mind-blowing transformation. And this right here, this is what that digital power looks like in real life. If you're a pre-approved customer, you can literally apply for a loan on their app and have the money in your account in less than 2 minutes. I mean, that's faster than it takes to make a cup of coffee. That is pure efficiency. Okay, so the strategy sounds great, right? The digital stuff is super impressive, but here's the real question. Did it actually work? Did it make them more money? This is the proof is in the pudding part, where we look at the hard numbers and see if this whole transformation actually paid off. And wow, this chart tells you pretty much everything you need to know. We're looking at return on equity, or ROE. It's just a fancy way of saying how good a company is at making money with the cash that shareholders invested. And look at that trend. It's more than tripled in just 4 years, jumping from about 5% all the way up to almost 16%. That is the definition of a successful turnaround. And it's not just the ROE. Their return on assets, which basically measures how profitable they are compared to their overall size, hit 1.63%. Now, what's really important about that number is who it puts them next to. According to this analysis, that puts KVB right in the same league as some of the biggest, most respected private banks in the whole country. They're playing in the big leagues now. But it can't all be sunshine and roses, right? No analysis is worth its salt without a serious reality check. So the source material is really clear about the fact that there are still some major challenges and, headwinds that KVB has to navigate.
So what are we talking about? Well, first, there's crazy competition for deposits, which are the lifeblood of any bank. Second, most of their business is still concentrated in southern India, so they're not as geographically diverse as they could be. Then you've got the risk of new regulations popping up, especially around lending. And of course, when you go all in on digital, you open yourself up to cyber threats and operational glitches. These are all real risks they have to manage.
And all of this brings us right back to where we started. If this bank has done this incredible cleanup, gone digital, and is now posting profits like a top-tier player, then why isn't its stock price reflecting that? Why is it potentially so undervalued? Well, the whole argument boils down to one key metric. Okay, so first, a super quick explainer on something called the price-to-book ratio, or P/B. All it is a comparison between a bank's stock price out in the market and the actual value of its assets on its books. It's a really common way to value banks. So a P/B of 1 would mean the market thinks the bank is worth exactly what its assets are worth. Simple as that.
And this right here, this is the core of the whole argument. It's all about the mismatch. You've got the bank's performance over here, which is top tier, right? We saw that ROE of almost 16%. But then you have its valuation over here, which is just kind of mid-tier. The market is only giving it a price-to-book ratio of about 1.68. See the disconnect? It's performing like a champion, but being priced like an average player.
And the analysis pretty much says it outright. This gap, this space between its amazing performance and how the market sees it, that's the whole investment idea in a nutshell. The bet is basically that the market just hasn't fully woken up yet to how real and, more importantly, how sustainable this transformation actually is. So, the argument goes like this. As KVB keeps putting up these great numbers, quarter after quarter, the market will eventually have to admit that this isn't just a one-time fluke. And when that happens, that valuation gap should start to close. The analysis projects that its price-to-book ratio will climb up towards 2.0x, which is more in line with its peers. And if that happens, well, that's how you get to that target price of 425 rupees we talked about at the beginning. So what's the big takeaway here? It's really a story of a massive transformation, right? We went from a risky past to a super solid foundation, from old school branches to a digital-first powerhouse, and from so-so profits to top-of-the-class performance. Which leaves us with the final multi-billion-dollar question. Is this a case of a century-old institution that has genuinely reinvented itself for the modern world? And is the market just late to the party?